All right, let's talk about an event that didn't just rattle Wall Street, it kicked in the front door of homes all around the world. We're talking, of course, about the 2008 financial crisis. Now, this isn't just some boring history lesson. No, this is a story about a system that completely broke down and the eternal lessons that were burned into our collective memory because of it.
I really want you to hold on to this image. Think of the entire financial system as the circulatory system of the global economy. It's the lifeblood. Credit is the oxygen that lets businesses grow and lets you and me buy homes. But, just like our bodies, a single tiny clot can send the whole system into shock. And what happened in 2008, that wasn't just a stumble. It was a full-blown catastrophic cardiac arrest, with Wall Street right at the epicenter. So the big question is, how on earth did we get there? Well, every huge fire starts with just a single spark. And in this story, that spark was a really intoxicating mix of pure, unadulterated greed and this grand, collective illusion that everyone bought into. Let's dive into how this fire really got started. Back then, the U.S. housing market wasn't just a market, it was almost a religion. The belief, and I mean from the guy on Main Street all the way to the fanciest office on Wall Street, was that home prices could only go up. It was this beautiful, shiny balloon, and everyone was just mesmerized, totally convinced it would just keep rising forever. But we all know what happens with balloons, right? They're only beautiful until they pop. Now, what's so fascinating about this whole story is that the truth, it was right there. It was there for anyone to see, but almost nobody bothered to look, except for a handful of people, like Michael Burry. This guy wasn't a Wall Street native. He was a doctor with this incredible, almost obsessive discipline for data. He did what literally no one else was willing to do. He actually read the fine print. And what did he find? Hidden in thousands and thousands of pages of mortgage contracts? He found the fatal flaw. He saw that the entire system was built on a foundation of sand. So what exactly did he find in there? He found these things, subprime loans. Let's just be blunt here. These were garbage loans. They were being handed out to people with no jobs, no income, and no assets. You might have heard of them, the infamous ninja loans. The whole logic was, hey, take the house now, worry about paying later, because everyone assumed rising property values would just cover the debt. These loans, they were the initial infection that got into the financial bloodstream. Okay, but how do you sell garbage loans to some of the smartest investors in the world? Well, you package them. The investment banks took thousands of these toxic mortgages, bundled them all together, and created a brand new product called a mortgage-backed security, or an MBS. It was basically a form of modern-day alchemy, a magic trick designed to turn lead into gold. And it worked, as long as the person buying it believed it was gold. And then, the financial wizardry went to a whole other level with something called a collateralized debt obligation, a CDO. So imagine taking those MBS products, chopping them up into different pieces, they called them tranches, and then stacking them. The top layers, which would get paid first from all the mortgage payments coming in, were considered super safe. And the bottom layers, well, they took on most of the risk if people started defaulting. This incredibly clever structuring allowed them to hide the poison so effectively that the big rating agencies would just stamp the top-level tranches with a perfect, pristine AAA rating. The exact same rating as U.S. government debt. Unbelievable. So where was all this crazy financial engineering happening? A lot of it was taking place in what we call the shadow banking system. Now, this wasn't some criminal underworld. We're talking about some of the biggest names on Wall Street, Lehman Brothers, Bear Stearns, the insurance giant AIG. They were operating as this kind of parallel financial system, largely outside the reach of traditional regulators. That meant fewer rules, fewer restraints, and a whole lot more risk. This is really where the storm started to brew. And this sentiment, this belief, it was everywhere. You hear these stories of real estate brokers back in 2006 making absolute fortunes, telling on their clients, this market is a rocket ship, it cannot collapse. That one phrase, it cannot collapse, basically became the epitaph for the entire era. It was the sound of supreme confidence right before the catastrophic fall. And this brings us to such a crucial point. The 2008 crisis wasn't just about bad assets or bad math. At its core, it was a crisis of trust. The trust between lenders and borrowers, between investors and the banks, between everyday people and the entire system itself. And it all started to unravel when one family in Nevada and then another one in Arizona just couldn't make their payments. The very first dominoes started to fall, and that sound, it echoed all the way across the globe. So that brings us to the second act of this story. If Act 1 was all about kindling the fire, Act 2 is when the entire structure was just engulfed in flames. This was the moment when a housing problem in America became a full-blown global inferno that threatened to consume absolutely everything. These were the days when all of Wall Street held its breath. September of 2008. That was the month the dam finally broke. It started with the government having to take over Fannie Mae and Freddie Mac, the absolute cornerstones of the U.S. housing market. Then, on September 15th, the unthinkable happened. Lehman Brothers, a 158-year-old titan of finance, filed for bankruptcy. The very next day, AIG, the world's largest insurer, was on the brink, needing a massive $85 billion government bailout just to stop a chain reaction of collapse. And by the end of the month, the Dow had its largest single-day point drop in history. It was just this cascade of failure, all happening in real time.
So why did Lehman die? It's a really important question. It wasn't because it was literally out of money. It was because it ran out of faith. Its assets, those supposedly golden CDOs and MBSs, were suddenly revealed to be nothing more than worthless paper. The firm was leveraged to the absolute hilt at a ratio of 30-1. Now think about that. That means a tiny 3% drop in its asset value would completely wipe out its entire capital base. When those first cracks appeared, faith just evaporated, basically overnight, and the firm simply ceased to exist. The accounts from traders who were on the floor that day, they paint such a vivid picture. One veteran remembered, "We walked onto the floor like we were entering a battlefield. No one spoke, no one laughed. We just stared at the screens and they were all bright red, like blood." This wasn't just a market correction. This was pure, unadulterated panic. Stop losses were getting annihilated, margin calls were screaming everywhere. The market's reaction was just instantaneous and brutal. In the hours right after Lehman's collapse was confirmed, the Dow Jones plunged nearly 500 points. Hedge funds were wiped out in a single trading session. For professional traders and investors, the fear was immense. They knew this wasn't just some dip. This was the flood. This here really shows you the toxic supply chain that made the crisis global. See, it started with reckless commercial banks. The shadow banks then acted as the distributors, packaging up the poison. Then you have the rating agencies, who were the compromised inspectors, just putting a stamp of approval on it all. And finally, global investors, pension funds in Norway, city governments in Germany, they bought all of it, thinking it was as safe as a government bond. The entire global financial bloodline was infected. Let me be absolutely clear about this because it's so important. The crisis of 2008 was not some random, out-of-the-blue black swan event. It was the direct, predictable consequence of a system where all the incentives were misaligned and completely fueled by unchecked greed. When profit becomes more important than prudence, disaster isn't just a possibility, it's an inevitability. And that brings us to our final act. If the first two acts were about the fire itself, this one is about what's left behind in the ashes. We're talking about the reforms, the scars, and the really profound lessons that continue to shape every single financial decision we make today. So, let's walk through this final door together. First and most importantly, we have to acknowledge the staggering human cost. These are not just statistics. 10 million families lost their homes. 8 million people lost their jobs. Foreclosure signs littered entire streets like tombstones for the American dream. It wasn't just concrete and steel that crumbled. It was the social fabric. It was the belief in a better future that was shattered.
In response to all this, Washington had to do something. The result was the Dodd-Frank Act, probably one of the most significant financial reforms since the Great Depression. It essentially tried to put handcuffs back on Wall Street. It forced banks to hold more capital as a safety buffer. It restricted their leverage. It dragged the murky derivatives market out into the light. And for the very first time, it created an oversight body to actually watch the shadow banking system. But laws can only do so much. The real lesson here is a personal one for every single investor. The market isn't designed to punish ignorance. It's designed to punish arrogance. It punishes those people who are so utterly convinced that they're right that they ignore all the evidence to the contrary. In 2008, the world was absolutely certain that real estate couldn't fall, and the market taught them a brutal lesson. Honestly, we see echoes of that same hubris today in all sorts of speculative bubbles.
So, if we boil everything down, what are the core, timeless truths that we learned from that inferno? First, that trust is the most valuable and fragile commodity there is. It can vanish in a blink. Second, finance, when it's left to its own devices, will not self-regulate. It needs discipline and it needs oversight. And finally, maybe the most important lesson of all, risk always has a price tag, and eventually the bill always comes due. And believe me, it is never cheap. I really want to speak directly to all of you for a second, whether you're a trader, a long-term investor, or just someone building your financial future. The smartest people in this game aren't just the ones who can sniff out the next big thing. They are the ones who master risk management, who know when the party's over. They understand that making money is hard, but keeping it is a hell of a lot harder. Surviving to invest another day, that is the ultimate victory.
So I'll just leave you with this one question, a question that every single one of us has to answer for ourselves. Do you want to be the person who learns from history and actually profits from its lessons? Or do you want to be another casualty, just a small footnote on the side of the next crisis? Because 2008 absolutely buried the blind, but it also made legends out of those who dared to see the risk when everyone else was completely euphoric. The choice, as always, is yours.